Over the last decade, the rollout of the Common Reporting Standard and FATCA initiated a global policy shift designed to end offshore tax evasion. The standard economic assumption here is straightforward. When the government begins receiving your financial data directly from a third party, hiding your income becomes mathematically irrational. In theory, automated data sharing drives the risk of detection as close to 100% as possible. We can test this assumption using granular administrative tax data from South Africa, spanning the rollout of the Automatic Exchange of Information, or AEOI. At first glance, the policy worked. When the AEOI activated, self-reported foreign income doubled almost overnight. This chart compares foreign financial income declared on tax returns against the income reported by foreign banks. The blue line is what taxpayers admitted to. The red line is the reality. Roughly half of bank-reported foreign income remains hidden. Look at the baseline period between 2010 and 2015. Taxpayer declarations were essentially flat, at around $200 million. Then, automatic information exchange begins in 2016. The blue line climbs to roughly $400 million and stabilizes. But incoming bank reports show the true total near $800 million. That leaves a stubborn $400 million gap of unreported income sitting in plain sight. This presents a mechanical contradiction. If the tax authority possesses the exact receipts from the foreign banks, why do taxpayers continue to evade? Data alone cannot change behavior. In a developing economy, the existence of information does not guarantee its systematic use in enforcement. To understand why this gap persists, we have to scale the dataset itself. We are looking at over 1 million foreign bank accounts definitively linked to South African taxpayers. This chart maps the macroeconomic footprint of that offshore wealth. The black line represents the estimated total value held in these foreign accounts. Between 2016 and 2021, the trajectory is unbroken, culminating in a peak of $85 billion. To put that figure in perspective, $85 billion is equivalent to roughly 20% of South Africa's gross domestic product. Breaking down the geographic location of these funds, the blue bars show that the vast majority of this wealth relies heavily on traditional tax havens rather than standard financial centers. The total volume of wealth shows the scale of the missing revenue. To understand the distributional impact, we have to look at the individuals holding it. This graph displays the baseline propensity to hold an offshore account across the general population. For the vast majority of income brackets, the rate is effectively zero. The line only begins its exponential sweep upward once it crosses the 99th percentile of earners. In terms of total volume, 20% of all aggregate offshore wealth is held strictly by the top 0.1% of income earners. By contrast, the bottom 50% of the country's taxpayers hold less than 10% of the offshore wealth combined. The failure to enforce taxes on offshore income serves to increase wealth inequality. These enforcement gaps effectively allow the entire tax system to become regressive at the highest levels of income. So, how did these different brackets of taxpayers actually react in 2016 when they realized their foreign banks would begin reporting them? This chart tracks the timeline of self-reporting, segmented by the size of the foreign account.
For accounts generating under $10,000, taxpayer behavior barely changed at all. Declarations stay relatively flat across the activation date. But for accounts generating over $100,000, the reaction was immediate. Reporting jumped nearly 200% right after the 2015 tax year. This creates a logical contradiction. If the wealthiest account holders surged their reporting, why does the massive $400 million gap still exist? To isolate the exact group responsible, we have to split these large account holders into two behavioral cohorts, shown here in Panel A and Panel B. Panel A isolates the ex-ante compliers. These are taxpayers who were already declaring their income before the policy change. Their self-reporting perfectly matches the bank data throughout the entire timeline. Panel B isolates the ex-ante non-compliers, the cohort that was previously evading. When the AEOI began, they did increase their reporting. That they intentionally stopped far short of their true balances, leaving a massive vertical void between what they declared and what their banks reported. The largest evaders didn't fully capitulate to global transparency. Instead, they made calculated partial disclosures, strategically gambling that they could still outsmart the tax authorities. Why would a rational, wealthy taxpayer choose to underreport when they know the government has their exact bank data? We can map the taxpayer's decision-making process using the Allingham-Sandmote tax compliance model. In this mathematical framework, the overall detection risk, represented by P, equals the probability of selection for an audit, multiplied by the probability of conditional detection once that audit begins. The public assumption is that automatic third-party data makes the probability of selection practically guaranteed. If your numbers don't match the bank's numbers, the system flags you. But South African audit data reveals an empirical inversion. Failing to self-report foreign income actually reduces your chance of being selected for an audit by 5 percentage points. This is driven by a mechanical failure in the system. Domestic tax authorities use self-reported foreign income to flag a return for balance sheet complexity, and that complexity flag is what triggers a human audit. By leaving the foreign income field blank, evaders bypass the complexity algorithms entirely. The system fails to automatically cross-reference their empty return against the incoming bank data. If audited for an unrelated reason, the conditional detection risk rises. The auditor checks the AEOI data, and the risk of getting caught increases by 5 percentage points. But when you multiply a severely lowered selection risk against a slightly higher detection risk, the overall detection risk collapses. It falls to a negligible 1% for the average evader. Look at this breakdown of underreporting by income group. Because the detection risk is so low, a massive spike in aggregate noncompliance is heavily concentrated right here, in the top 1%. The ultra-wealthy are acting as highly rational economic agents. They understand the structural limitations of the tax authority, and they optimize their evasion accordingly. Global transparency pacts are useless without domestic capacity. To close the 50% gap, developing nations must abandon complexity-based human audits and rebuild their systems around automated, algorithmic data matching.